Every day, the world appears to become more interconnected. If you watch any financial television channel or read the news online, you are probably aware of how events in one country seem to have an ever-increasing impact on events in other countries around the world. Certain aspects of globalization can be beneficial, but when threats such as a financial crisis, war, global recession, trade imbalances, and so on arise, it frequently leads to talk of shifting money to safer investments and increasing government deficits. Even the most knowledgeable investor can become perplexed by the rising uncertainty. In this video, I will explain the impacts of uncertainty on investing and strategies to help you invest in uncertain times. What is the effects of uncertainty on investing? There is an inherent level of risk whenever money is put at risk in the pursuit of profit. When new threats emerge, such as war or recession, the level of uncertainty rises significantly, because companies can no longer predict their future earnings accurately. As a result, institutional investors will reduce their holdings of risky stocks and shift funds to other asset classes such as precious metals, government bonds, and money market instruments. This sell-off, which occurs as large portfolios reposition themselves, has the potential to depreciate the stock market. The inability to predict future events is referred to as uncertainty. People cannot predict the extent of a potential recession, when it will begin and end, how much it will cost, or which companies will be able to survive it. For the investing public to follow, most companies typically forecast sales and production trends. However, as market uncertainty levels rise, these predictions may become significantly less accurate. Uncertainty can have a negative impact on the economy at both the micro and macro levels. Uncertainty on a micro level focuses on the impact on individual businesses within an economy threatened by war or recession, whereas uncertainty on a macro level focuses on the economy as a whole. Firstly, let me explain the micro risks. Uncertainty is a major concern for those who manufacture consumer goods on a micro level, company-specific level. For example, the threat of a recession may cause consumers to refrain from purchasing new cars, gadgets, and other non-essentials. Because of the uncertainty, companies in certain industries may be forced to lay off some employees in order to mitigate the effects of lower sales. The level of uncertainty surrounding a company's sales pervades the stock market as well. As a result, when levels of uncertainty rise, stock prices of companies that manufacture non-essential goods sometimes fall. Secondly, I will go over macro risks. On a larger scale, if the countries at war or major suppliers are consumers of goods, the uncertainty is amplified. A country that supplies a large portion of the world's oil is a good example. If this country goes to war, there will be more uncertainty about the world's oil reserves. Because demand for oil would be high and supply would be uncertain, a country unable to produce enough oil within its own borders would be required to store enough oil to cover operations. The price of oil would rise as a result. Another macro-level event affecting businesses and investors is capital flight and currency depreciation. When a country's economy is threatened by war or recession, it is considered uncertain. Investors try to change their currency from volatile to stable sources. The currency of a country under threat of war may be sold, while currencies from countries not under threat are purchased. The average investor is unlikely to do so, but large institutional investors and currency futures traders are likely to do so. These actions cause exchange rates to fall. What is the investing strategies for uncertain times? When faced with situations involving high levels of uncertainty, the best defense is to be as well informed as possible. Follow market news and research individual companies to stay up to date. Determine which sectors have the most to gain and lose during a crisis and devise a long-term strategy. Times of increased uncertainty can provide excellent opportunities for investors who position themselves to capitalize on them. Some investors may decide to go on the offensive and seek out companies that offer goods or services. That will result in high returns when things improve. It's hard to invest capital during uncertain times, but it can often pay off handsomely in the long run. Those seeking to reduce uncertainty and risk may be content to leave their money alone or to move it to safer securities. Diversification is an important investment strategy at all times, not just during times of uncertainty. Spreading your investments across a variety of assets, such as stocks, bonds, and precious metals, helps to soften the blow if one area depreciates rapidly. Diversification is also increased by investing in various regions, sectors, and industries. For example, if you had all of your investments in oil companies and oil prices plummeted, Due to the outbreak of war in the Middle East, you would face significant financial loss. If you also had investments in the technology and renewable energy sectors, your portfolio would be less affected. Regardless of which strategy you choose, you can't go wrong in the long run by staying informed and positioning yourself to profit when prices fall. Having the ability to stay up to date on news and adjust your portfolio accordingly will allow you to invest wisely during uncertain times. Thanks for watching. I hope you enjoyed this video and learned something new. If you liked this video, please give it a thumbs up and leave a comment below. Don't forget to subscribe to stay up to date with all our future content. Thanks again for watching, and I'll see you in the next one.